what an asset is future deferred consumption. You buy an asset to maintain value so you can do something with it. Now, the S&P's done a good job at offsetting debasement, but it hasn't gone up. So you haven't actually got richer, you've maintained the same. Gold has done a terrible job in all of this. Right. Real estate does underperform, but don't forget most real estate uses leverage, so it actually probably ends up a bit better. So it probably looks more like the S&P. But none of these things have added to your wealth. The only things that have added to your actual wealth, i.e. your ability to buy more in the future of other assets or whatever, is technology and crypto.
Raoul Pal, the founder and CEO of Real Vision, is forecasting an explosive bull run for cryptocurrencies and technology, two asset classes he believes will usher in the next stage of the exponential age, when all the seas of technological advancements that have been so significant in recent decades will start to bear fruit at breathtaking rates. The hallmark of this era will be high-tech innovations and amazing technological forces that we can hardly comprehend. These innovations will make our daily tasks faster, more effective, and, most importantly, easier. Raoul Pal claims that the numerous failures of the current financial and economic systems have made the push for the next phase of human progress essential. He thinks that in 2008, there was a global economic reset when the main nations of the world realized that the two key drivers of GDP growth, demographic and productivity growth, are either stagnant or declining. Nevertheless, debts have continued to rise and have, at various moments since then, exceeded 100% of GDP for the majority of these economies. He thinks central banks determined the best course of action to postpone the inevitable was to list debts on their balance sheets, and occasionally generate money to maintain the weak economy's stability. However, by doing so, they reached a limit beyond which they can no longer turn, forcing them to constantly and continuously give liquidity to maintain the balance. Raoul Pal claims that he is usually bullish on asset prices, both in the short term and the long term, since central banks will continue to inject money into the economy, giving the markets enough liquidity to sustain asset values for an extended period of time. Raoul Pal, however, points out that the traditional asset classes are not actually expanding in real terms, rather, they are merely reacting to continuous liquidity pumps without any genuine appreciation or value, because the liquidity being provided may result in continuous currency devaluation without any genuine improvement in purchasing power. According to Raoul Pal's theory, the only way to reverse the GDP crisis is to boost productivity growth. This is where blockchain technology and the exponential age come into play, which is why the macro expert is so positive on these two key asset classes. Please watch the entire video, subscribe to the channel, and don't forget to give the video a thumbs up if you found it helpful.
It's difficult to put it all into one place, but essentially the world that we knew is broken. It's broken because of demographics. So if you think of, I call it the magic formula. What is GDP growth? GDP growth is basically population growth plus productivity growth plus probably debt growth. And debt growth kind of robs the future to create current growth. And when you look at those three factors, most of the Western world plus China are seeing shrinking populations. The US is kind of flattening, not shrinking, which is why the US trend rate of GDP growth is somewhat higher than Europe and Japan, and China's still a bit different because of the stimulus packages. Then we look at productivity growth, and it's been declining for a very long time now. And so we have a decline in productivity, either declining population or slowdown of population growth, and debt growth reached its limit in 2008. And this is the key part. So really what GDP growth does is finance investment and also debt payments. When a government gets to 100% of GDP in debt, which the EU, Japan, US did, and UK's just done so last week, if they're 100% in debt and the trend rate of GDP is, let's say, 2%, to make easy maths, and interest rates are at 2%, 100% of GDP growth goes to paying interest. Because every year you've got to pay the interest that needs to come out of GDP. So that means the economies wouldn't grow. Now, it used to be covered up by debt growth, but what happens now is that the private sector is over 100% of GDP in debt as well. So you're competing for the GDP to service the debt payments. And the answer ended up being in 2008 is we will just put it on the balance sheet of the central bank. And the Everything Code, part of the Everything Code, which is a very big, broad thesis, proves as much as I can that all interest payments are just the monetization of the debt from about 3.5 years ago. Why 3.5 years ago? It's this 3 to 5 year window. The economy has come very cyclical because in 2008, we actually got the great reset that people have been waiting for. The reset was saying, okay, interest rates don't count anymore, they're all going to zero. So everybody can service their debt. Right? People haven't framed it in these terms, but that's what it was. And then everybody refied their debt. And governments have generally, and corporations generally have refied in the 3 to 5 year sector. So you get this 3.5 year cyclicality of the economy that debt payments come due, the economy slows down, rates get cut, we keep going through the same cycle over and over and over again. This one got somewhat skewed by COVID and what it did to demand, supply. So it created a larger inflation shock, but generally the framework is still there that the central banks need to monetize the interest payments or the economy compounds negative forever. That's a big thing to get your heads around. And I've proven that the US has done it, Europe's done it, Japan has done it, and the UK have done it. I think there is a global central bank agreement that they need to keep interest rates down below trend rate of GDP growth when it comes to rolling these payments. That is the key part. And those interest payments are what's driving up the central bank balance sheets. The central bank balance sheets are liquidity, and we'll talk a bit about the liquidity element later, but what they actually are is debasement of currency. You're basically borrowing money to pay off the interest on the other money, and that's a pure debasement of currency. And that optically makes assets go up in price. Optically, because it's actually the denominator that's falling and not the asset prices. So with part of the Everything Code, I changed the denominator for all assets to the global central bank balance sheets and found out that most markets had gone nowhere once you look at it in those terms. They all look more like Europe did, which was a sideways ranging market. And that was the S&P went nowhere, real estate went nowhere, gold went nowhere. But there were two that did, which was technology and crypto. And I'm like, what's that all about? And that was this realization that got me to the exponential age, which preceded this whole thesis, that those are not only driven by the debasement, but they outperform because they're driven about technological adoption. So they're driven by Metcalfe's law and other factors. So what I then found out is when we built a liquidity formula for GMI, myself and Julian Bittel, and we found that according to our measures of liquidity, the NASDAQ, the S&P, all of these things, let's use the NASDAQ, 97% correlated with liquidity, particularly the central bank balance sheet, because it's the denominator. And we can then forecast into the future by using a lot of the work that we do in GMI, where liquidity is going to go. We also know what the central banks are going to do because they monetize their debt 3.5 years later. So we can actually build out models into the future where we think liquidity goes. And if assets are 97% correlated, we can forecast assets out into the future as well, which is what makes it an Everything Code. Now, it's a hypothesis, a thesis, needs to be tested. It's very bullish on assets going forwards because we're in the point in the cycle where economic growth is falling, inflation is falling, unemployment will start rising. And at that point, you tend to get stimulus over time. And we've seen the central bank balance sheets. The Fed used theirs for the banks. We saw Japan with the yield curve control, the UK bailing out its pension system. So bit by bit, we're starting to see the return of the debasement. And over time, it should accelerate at this point in the cycle. And that gives us a very good backdrop to assets, particularly crypto, which is the fastest horse in the race.
If you look at the S&P 500 relative to the Fed balance sheet, zero excess return. When you look at real estate and gold, net losses.
So what that means, because people are like, okay, I don't really understand what it means. What it means is you've got no wealthier by owning the S&P 500, even though it's gone up.
Right.
So what an asset is future deferred consumption. You buy an asset to maintain value so you can do something with it. Now, the S&P's done a good job at offsetting debasement, but it hasn't gone up. So you haven't actually got richer, you've maintained the same. Real estate is the little bit confusing. Well, gold, let's deal with gold. Gold has done a terrible job in all of this, which was surprising to me. I thought it would have done better. Right. Real estate does underperform, but don't forget, most real estate uses leverage, so it actually probably ends up a bit better. So it probably looks more like the S&P. But none of these things have added to your wealth. The only things that have added to your actual wealth, i.e. your ability to buy more in the future of other assets or whatever, is technology and crypto.
Raoul Pal claims that even though it doesn't seem to have gone up in real terms, it's still far more difficult for the typical American to buy it now than it was 3 or 4 decades ago. The same is true for all other asset classes, including real estate. This is due to the fact that salaries haven't increased in real terms since 1972. Consequently, he thinks it's financial suicide to only rely on one's salary to increase wealth rather than investing in assets. You can at least keep your purchasing power with assets like S&P while doing much more with cryptocurrency and technology. What do you think of Raoul Pal's thorough examination of the Everything Code and the continuous liquidity loop at the Federal Reserve? Please share your thoughts and views in the space provided below. Make sure to like this video, subscribe to the channel, and enable post notifications if you want to see more like it. Thank you for watching.